Okay, we're going to continue talking about the mortgage market chain, but we're going to look specifically at price discovery. If you've had a chance to look at the first session, you'll notice that what I talked about were the different entities that were involved and some of the main reasons why so much mortgage paper was issued, packaged and resold, and then packaged and resold again, and how it began to break down and some of the root causes. This time we're going to look at the piece that we didn't get to look at as in detail, which is the price discovery mechanisms in that market. So what we're going to look at here, again, if you remember, the three main players were the banks and brokers who had the originate and sell model, the GSEs, Fannie and Freddie, who bought the packaged mortgages, and then they packaged and resold them to investors who invested in these assets, which were mainly mutual funds, pension funds, and foreign banks, and expecting a specific cash flow from them, and they were the ones who would ultimately buy and hold. So let's just look at, in the next few moments, let's look at this market chain and what I'll call the price discovery issue in the market chain that was one of the main players, one of the main problems with the market chain, and what actually opened the door, if you will, to much of the issue and much of the problem. So if you think about, again, let's just think about basic market theory, that in a market you have a buyer and a seller. You have someone who says, I have a book for you, it's an antique book, and I believe it's worth $1,000. It was written by someone in the 1800s, very famous author, and it's an original edition, and it's worth $1,000. And if you're a buyer of antique books, you're looking at this one and you're trying to evaluate it before you spend your $1,000 to see how much it's really worth. And in this specific situation, you may go to a third party who is an expert in antique books to understand what should I really pay for this book. Is he overpricing it at $1,000, or am I getting a great deal at $1,000 because 3 or 4 of them were sold worldwide unknown to the seller for $1,200? So this, in every market, there's price discovery, or nothing would be sold, whether it be a TV set, a car, an antique book, or a mortgage. These are all assets. A book is an asset. It has something that has intrinsic value. A mortgage is an asset. It's just a financial asset, a little more difficult to understand, and unfortunately that's one of the main reasons why we've had the problem that we've had. So it's important that you understand the basic functioning of a market. Everyone works in markets every day, whether it be going to the Salvation Army to look at used clothes, or whether it be going down to the dealership to look at a new car. A market is basically someone who's selling something and another interested party in buying. But very basic understanding of markets are needed to understand how this works. In the last lesson, we talked about the demand-pull problem with this mortgage market, this market chain. Basically, although the banks, which I believe, again, I'll say again my opinion, banks are getting unduly criticized for this. The banks and mortgage brokers originated mortgage paper, packaged it, and resold it to the secondary market. Now, it's interesting to understand that this has been going on for a long, long time, packaging mortgages and reselling them in the secondary market. It isn't just something that happened in 2002 through 2007. It's going on for decades. The problem here really enters in when we're talking about the new creative type of financing to allow people of, partial credit who maybe shouldn't have gotten mortgages to start with, or maybe we prematurely issued a mortgage on that person when they probably could have gotten one after a couple of years, a few more years more before we should have okayed that mortgage. But we're packaging these mortgages and selling them to the secondary market. This has been going on for a long time, decades. And the secondary market would then resell these as bonds to investors. And so these investors were basically buying repackaged mortgages for their portfolios, which up to recent times have been fairly safe and quality paper. So it's, again, just a quick reiteration of the market chain to understand why this is going on. But right now I want to specifically talk about the rating agencies. Because if you think about it, whether it be the antique seller we were just talking about, the bookseller, and the book buyer who may either have a tremendous amount of knowledge and not need a third party to evaluate an asset, or Kelley Blue Book for a used car, which is a great example of a third party service that you're using to evaluate a used car. Kelley Blue Book would compile the prices of used cars in a certain area and help you understand what a used car is worth, whether it's in good shape, great shape, or outstanding shape, etc. In the mortgage market, the third-party player that helps us understand valuation are the rating agencies. The rating agencies specifically are financial analysts, groups of financial analysts and companies, S&P, Standard & Poor's that stands for, Finch, and Moody's are the main players. And these players would then evaluate these packaged financial assets and say, these financial assets are subprime. These subprime financial assets are worth X. We expect their cash flow to be X and their loan losses to be Y. In light of that, the GSEs would then buy these and be able to repackage them, and then the rating agencies would step in again and say, okay, these assets may be a mixture of subprime, Alt-A, and prime paper, and we believe that they're going to have a cash flow of X and a loan loss rate of Y. And then the investors therefore could say, okay, with confidence, I want to buy those subprime pieces of paper because I know I'm going to get this cash flow because I've done my due diligence and understood what the ratings of these mortgage bonds are, and I'm expecting this kind of payout. So if you think about it, the key linchpin here of understanding one of the breakdowns has to do with how these were rated. Now, without putting all the blame on the rating agencies, first of all, it's interesting to understand that this market grew pretty quickly here in the 2000s, especially as there was a mandate on our GSEs from which is a government-sponsored entity, in order to originate more mortgages in the subprime area. Fannie Mae and Freddie Mac, which are the two government-sponsored entities in the mortgage market, had a mandate to enter into the subprime mortgage area and begin to buy paper in bulk that was subprime in origin in order to facilitate lending to lower-income tranches of the population. So a very noble thing to do. However, it would only work if the subprime paper was priced correctly and facilitate the market in an orderly and transparent way. And that's one of the key words, is transparent, because as these assets move along the market chain, they become less transparent. So in order to evaluate mortgage paper that's coming from the bank to the GSEs and investment houses, those assets would be rated based on the basic terms of the mortgage and whether they're subprime, Alt-A, or prime. And a valuation could then easily be put on that paper when they were bought. The problem comes in is when the GSEs and investment banks package and resell those bonds to investors, so they may look a little different. These structured investment vehicles, or SIVs, were where investors could buy specific tranches of the paper, and these became more and more opaque, in other words, difficult to understand, even for the analysts. So you had two things playing against the analysts. First of all, these financial instruments, these bonds, became very complex in the last several years. Secondly, they're kind of a new thing because subprime mortgages weren't being issued at that rate. So you have two major issues here. First of all, the complexity of the mortgages, the mortgage-backed securities, these SIVs that were being sold to investors, and then the pure volume, being able to rate them, having time to do it correctly because there's so much demand pull. Nonetheless, these mortgages, as they came through in this mortgage-backed paper, and these SIVs, as they came through the system, were rated, and investors were then the purchasers, the end buyers of these cash flows, making an assumption based on the ratings that they were going to produce a certain amount of revenue, a certain amount of cash flow payments over time. Well, of course, what happens is mistakes were made in valuation. The subprime paper especially was expected to produce at a certain level, and of course didn't meet that level. And the investors were the first ones to understand that when bond payments weren't made, when funds that owned a bunch of this subprime paper all of a sudden found out that we're not getting what we thought we were going to get out of this. This isn't as good as we thought it would be. I don't want any more of this.